Hello everybody, today's video is about limited companies and the financial statements of limited companies. So there are two types of limited companies. One is a private limited company and the other one is a public limited company. When it's a private limited company, we can sell shares to the friends and family in case of private limited companies. And in case of public limited companies, anybody can invest in a public limited company. So there are thousands of shareholders in public limited companies, and because public limited companies are huge, their capital is also very huge. So for this particular topic, there are three things that the students need to know. One is the income statement. So I'm just talking about the numericals here, where students are tested on the numericals. So one is that you need to know the income statements. So normally whenever we make an income statement for a sole trader, it's just like that for the limited companies as well. So what we do is that we reach to the profit for the year in case of the income statement of a limited company. And then what you need to do is that you need to make a statement of changes in equity. So what statement of changes in equity is basically capital, and this is the capital that is provided by shareholders in case of companies. And whatever changes are happening in the capital, you need to show that in the statement of changes in equity. And then there is a statement of financial position. So statement of financial position is just like the normal statement of financial position, only the difference is that there's the capital section is different. So capital section will have equity and reserves of shareholders, the capital section of the statement of financial position of limited companies. Basically the statement of changes in equity is important for the capital section of the statement of financial position for limited companies. So we'll just start with statement of changes in equity. What does the format of statement of changes in equity look like? So if you guys look here, there are these headings. There's one thing called share capital, and then share capital is basically here. Normally it's ordinary share capital. So ordinary share capital is it's the amount of money that is raised through issuance of shares. So that is, let's say for example, whatever the price of one share is, so price per share, and we multiply this by the number of shares, so that gives us the value of shares. So this is pretty important if you consider that, because if let's say whatever the price per share is, let's say it's $1 and number of shares is 500,000, so your value of shares is also $500,000. Share capital is exactly that. So here basically in this one there are balances at start. So at the start of the year, how much money did we have in our share capital? Basically, how much have we raised through issuance of shares? Then we have general reserve. So general reserve is a reserve that is made out of profits, and retained earnings is also a profits reserve. So whatever the company is earning every year, they keep on putting it in the retained earnings. So whatever the profit for the year is, it basically goes to the retained earnings. So what we'll do here is that then there is a total heading. What we'll do here is that we'll take out balances from the question: share capital, general reserve, and retained earnings, and then total all of them. Then if there's a share issue in the question, you need to record that, and you need to record that in the share capital section, because share issue will increase your share capital. And then again, profit for the year will be put into retained earnings, because retained earnings is where you basically accumulate all profits. There is an interim dividend. So interim dividend is mostly a half-year dividend, a mid-year dividend, which will be paid out. If it's paid out, then you write it in the statement of changes in equity. If it's not paid out, if it's just proposed, then you don't write it in the statement of changes in equity. So interim dividend, if it's paid, you need to subtract that from the retained earnings. And obviously because it's paid out to shareholders, so it's not part of equity anymore. So obviously you need to subtract this from here, and then obviously the row total will also be a negative value. So what we are doing here is basically that we are writing these row totals. So share capital plus general reserve plus retained earnings is this total, and every row is basically totaled. So share issue, it's just increasing the share capital, and then you write the total in the total column. Okay, then there's a final dividend. If you have paid out a final dividend, okay, you'll have to subtract that from profits, that is retained earnings, and then you obviously this will also be a negative value in the total because that's out of the equity, it's not part of the equity. Then there is transfer to general reserve. So transfer to general reserve is just like you are taking out money from one reserve and then adding it to another reserve. So there's a general reserve that maybe can be used for future expansion, for example expansion of the limited company. So you subtract that from retained earnings and you add it to general reserve. So the total is basically zero because it's like you're subtracting it from retained earnings, adding it to general reserve. So the total, it's like one negative and one positive will cancel off with each other. Then we have balances at end. So balances at end for share capital, general reserve, retained earnings, and then this total is basically this total. All of these should equal to this, and all these three should equal to this. So that means it's like column totals and row totals are equal. So these balances at end, these are important for statement of financial position, because when you're making the statement of financial position in the capital section, you'll write ordinary share capital, then you'll write general reserve, then you'll write retained earnings, and basically you'll write all these balances at end because we make the statement of financial position at the end of the year. So this will be the closing value of equity and reserves. So there is a section in the statement of financial position for capital section, it's called equity and reserves. So equity and reserves means these three: share capital, general reserve, retained earnings, and that's it. That's and then you total it. There's one type of shares, those are called preference shares. Preference shares, normally in these type of questions, they haven't tested in numericals. So in CIE exams, you don't have numericals for preference shares, but you have numericals for ordinary share capital. And this is exactly the share capital in the statement of changes in equity as well. Okay, this is a question that I have taken out from October-November 2022, paper 21. This is question number 5 of that paper. And this basically is going to test you on statement of changes in equity. And then there are some formulas that you need to use from ratio analysis. So here they are saying the following information is taken from the statement of financial position of C Limited at 1st September 2021, which means it's the starting balances because they've said 1st September 2021. The year ends basically on in 2022, 31st August 2022, that's the year end. Then they are saying we have a 5% debentures, which means 5% is the interest. This thing tells me that these need to be repaid in 2024. This is for $60,000 that we have raised from people as loan. So debenture is like a very huge loan that you are taking from the general public, because at some point you cannot raise finance through a bank or something, and it's a very huge loan, so you just take it from general public, and that huge loan is basically divided into small loans that we take from general public. So everybody would lend us some money, okay? Then that is how we finance basically. It's like a long-term liability, and it's like a source of finance. So then they're saying equity, we have 3 balances for equity. This is also starting balances. One is ordinary share capital, the other is general reserve, the third one is retained earnings. These are balances at start. So ordinary share capital, if you look here, like I told you guys, this formula, price per share multiplied by number of shares is equal to value of shares. So here the price per share is $0.5. And we don't know the number of shares, that is X here, because 1 share is for 0.5. This tells me it's 1 share is for $0.5. And number of shares, we don't know how many number of shares we have, but we know the value of shares because this is like in dollars, right? All are these values. So all of these are values. So the value of shares here is 240,000. So when you write here X is equal to basically 240,000 divided by 0.5. So what I have done here is total value of shares divided by value of 1 share will tell me the number of shares that we have issued. So the number of shares that we have issued here is 480,000. Every share is for $0.5. Then they're saying during the year ended 31st August 2022, they're saying there's a final dividend payment that they have made. That is 12,000 was made for the year ended 31st August 2021 was the previous year. The current year here is 1st September 2021 to 31st August 2022. So for the last year, they must have proposed a dividend last year, which they have paid out this year. So this will go in our statement of changes in equity. Then they're saying an interim dividend payment of 0.02 per share was made for the year ended 31st August 2022. This is for the current year, and they have announced it and they have paid it as well. So because they have written here that there's an interim dividend payment made. So this is also going to go into my statement of changes in equity. Then they're saying a transfer of 11,000 was made to the general reserve. This also goes to the statement of changes in equity. Then they're saying at 31st August 2022, the company proposed a final dividend of 10,000 for the year ended 31st August 2022. This is not supposed to go in my statement of changes in equity because, like I told you guys, proposed dividends are just announcements. They are not actual payments. They're not reducing our profit. Their dividends basically it's like a profit distribution to shareholders. But if you have paid out dividends, you subtract that in the statement of changes in equity. But if you've just proposed dividends, that means we have just announced a dividend. We haven't paid out a dividend. Then they're saying the revenue for the year ended 31st August was 310,000. That's the total revenue. Then they're saying the profit before debenture interest was 23,000. Debenture interest here will be 5% of 60,000. Which will be 3,000. And then profit before debenture interest was 23,000. So 23,000 is my profit from operations. From this, I need to subtract the interest expense, which obviously the company needs to subtract from profits. Then we are left with a profit for the year of 20,000. This is going to be written in the statement of changes in equity. So profit for the year goes to the statement of changes in equity. So what I'll do here is I'll start with opening balances, because in my format I wrote balances at start, that is balances at 1st September 2021. This is the first date of the year. I'll write here ordinary share capital is 240,000, the value of shares. General reserve here is 36,000, the value of general reserve. 22,000 is retained earnings, and the row total will be 298,000. Then what I need to do here is there's a share issue thing in the format, but share issue is not here in this particular question. So I'll move on to profit for the year that I will add in retained earnings. So I'll write here profit for the year. I'll write here 20,000 in retained earnings, and the row total will be again 20,000. Then what I need to do here is that I need to subtract all the dividend payments. So first dividend payment, the last year's dividend payment will actually be made first. So I need to subtract that first. So I'll write here final dividend final. I'll write here 12,000. I need to subtract that from my retained earnings. And then obviously the row total will also be a negative 12,000. Then I will write here dividend interim. So here what they have said here, they have given you per share dividend. You need to convert it into total dividend. So here per share dividend is $0.02, and you multiply this by the number of shares that the company has, that is 480,000. The number of shares. So when you multiply 0.02 with 480,000, you get a value of 9,600. This is my interim dividend of the current year. So I need to subtract this from my retained earnings. I write here 9,600 negative, and the row total will also be 9,600 negative. Then there is a transfer to general reserve. So I write here transfer to general reserve. I need to subtract this from retained earnings. So profits, basically it's subtracted from the profits and then another reserve is created. So I'll add it to general reserve. I'll write here 11,000 and the row total will obviously be 0. So negative 11 plus 11,000 will give you a 0 value. Then you have balances at end, which you'll write here. Balances at 31st August 2022. This is my balance at end. So now what I'll do is I'll obviously take out the total. So share capital total is 240,000. There's no change in the value of share capital. We have 47,000 for general reserve, 36,000 plus 11,000, and then for retained earnings my value comes out to be 9,400. And then the total comes out to be 296,400, which is also my basically my column total. All of these values, these values. So all these values total to 296,400, and these values 240,000 plus 47,000 plus 9,400 also add up to 296,400. Then you need to calculate return on capital employed. So in the next part, they're expecting you to calculate return on capital employed. So what I'll do here is I need to know the formula for capital employed. I cannot do it without the formula. So I'll write here profit before interest. So if you have a debenture, if you have long-term liabilities, then you need to take profit before interest in the numerator. If you do not have a long-term liability, then there's no interest expense either. So profit from operations, and basically profit from operations is the other name for profit before interest. So if you don't have a long-term liability, then profit before interest and profit for the year is the same. But in case of having a long-term liability like this, like in this question, we have debentures, you need to take profit before interest in the numerator. You divide this by capital employed. So capital employed is also a formula. Capital employed in case of companies is equity, that is share capital, plus reserves. So reserves are two reserves, that is general reserve and retained earnings. And then obviously we have a non-current liability here, that is debentures. So that is going to be my capital employed. Then I multiply this by 100. So profit before interest over here is 23,000, like they have given this in this question. Profit before interest is 23,000. So I write this 23,000 in my numerator, and then in the denominator I need to take this value in the denominator, that is 296,400, which I'll write here 296,400. And then I'll multiply this by 100, so I'll get a value of 6.45%. This is expressed in terms of percentage. So as students of accounting, you must know that you need to write the formula and then write the values, so the examiner knows that you know the formula. Then we have, then in the next part they're saying calculate to 2 decimal places the profit margin for the year. So profit margin, again, it's also a formula. So I'll write here profit for the year divided by revenue multiplied by 100. So profit for the year here is 20,000 because 3,000 was the interest expense. So profit before interest minus 3,000, that is interest expense, then gives you 20,000. You divide this by revenue 310,000 and you multiply this by 100, you get 6.45%. That is my profit margin. In the next part, they're saying suggest 2 ways in which profit margin could be improved. So profit margin can be improved if we have good control over our expenses. So we need to see our expenses and try to control them. So the business should try to cut down on their expenses. So the business should try to cut down on their expenses. That is one thing. So the other expenses, so if you guys know the income statement format, we have revenue minus cost of sales gives us gross profit, and gross profit, then you add other incomes. So that is going to improve your profit margin if you try to have more other incomes. or you need to control the other expenses which we subtract from the income statement. So if these other expenses are controlled, your profit will increase. So that is also going to improve your profit margin. Then if you also if you can also in a way, you know, improve your gross profit margin. So if you try to control your you try to cut down on your cost of sales. So when how do we do that? By, you know, sometimes you can obtain cheaper supplies from somewhere else, and you know that reduces the value of your purchases and then reduces your cost of sales and increases gross profit. So if you try to increase your gross profit margin, that is also going to improve your profit margin. So the business should try to obtain cheaper supplies to improve their gross profit margin. Obtaining cheaper supplies will cut down on the quality of the goods that you are selling. So it's not a very good measure, but it's one of the measures of improving profit margin. Also, increasing selling prices can also improve profit margin, because that increases the profit that you are going to charge from your customers. But that also can you know, basically your customers can find other suppliers for those goods. So if we increase price, we should always see the competitor's price so that we price it accordingly, price our products according to that. In the next part, they are saying, C Limited plans to buy additional premises. Two options are being considered to raise the finance required. Option number one is issue 6% debentures to raise $65,000. So they need to raise $65,000. What they're trying to do is that they want to either issue 6% debentures, that's a long-term liability. The other option is that they issue additional ordinary shares to raise $65,000. So what you need to do is that you need to evaluate two options. So how do you evaluate the two options is that you need to first take the first option and then, you know, write about the pros and cons of the first option. So the first option is issue debentures. So the advantage of issuing debentures is that you are just getting a non-current, like a long-term liability. What happens is that when you are issuing ordinary shares, that just dilutes the ownership of the current shareholders. So let's say there is this company, we'll just take a hypothetical example. There's this company and there are 10 shareholders in that company. So in reality, that's not the case. In reality, we have thousands of shareholders, but in, let's say, just for an example, if there are 10 shareholders, so these 10 shareholders own the company, right? But if we issue additional ordinary shares, that means now more shareholders will own the company. So that just dilutes the ownership of the current shareholders, means that the ownership will now be shared with more people. So the disadvantage of issuing ordinary shares is that the ownership of the current shareholders dilutes. So ordinary shares disadvantage is dilution of ownership of the current shareholders. So dilution of ownership is the disadvantage. The advantage of issuing debentures is that the ownership of the shareholders will not dilute. So the ownership stays intact. The disadvantage of issuing debentures is that you need to pay them interest. So debenture holders will be pay them fixed interest every year. So whether you make a profit or no, you need to pay fixed interest to the debenture holders. The other thing is that these need to be repaid. So these need to be repaid. So there will be a point where you will have to repay your shareholders the amount that you have, repay your debenture holders the amount that you have raised from them. In case of issuance of shares, the advantage is that dividends are basically not fixed. So dividends are not fixed. And for ordinary shares, you really don't, the dividends basically depend on profit. So if there is no profit in a particular year, the company will not pay dividends to the ordinary shareholders, and it's fine. In the next advantage here could be that ordinary share capital does not need to be repaid. So these are my advantages of issuing ordinary shares. But the disadvantage here is that the ownership gets diluted. Disadvantages for issuing ordinary shares. Also, by issuance of debentures, the profit that is left for the shareholders, the ordinary shareholders, will obviously be reduced, because there's this thing, profit from operations. Then you subtract the interest expense from that, then you get profit for the year, which is added to retained earnings in the statement of changes in equity. So your paying interest basically will reduce profits. So reduce profits available to shareholders. Okay, so what you need to do is that this is how you evaluate each option in this case, and you justify by advantages and giving advantages and disadvantages. There's one more thing that you can add here, is that debenture holders, when you need to, in case of the winding up of company, the winding up means that the company, if it goes into a lot of losses and it needs to close down, the first thing that they need to pay off is the debenture amount that they have raised from people, so that they are given the first preference. So because they are loan providers, they are not capital providers, so ordinary shareholders are given the least preference. So in most cases, when companies go bankrupt, ordinary shareholders are the last one to receive the investment that they have made. So that's it. So ordinary shareholders get the least preference in case of winding up of the company. So there's first thing is debenture holders are returned their money, then preference shareholders are returned their money, and then if anything is remaining, then ordinary shareholders are repaid the money that they have invested. So that's it for this question. Hope this helps you guys. Thank you so much for watching.